Hey, what's up, YouTube? Really quickly, I want to go over why I don't buy short term options because they're just way too volatile for my liking and my risk profile, and I kind of think they're almost like gambling. So, let's just get into my thoughts. Why I don't like to buy options, but rather I would like to sell options. And so, here's a trade that I put on with maybe um, a portion of my portfolio because I want to be hedging for the downside in certain occasions, and so that's why I like to hedge with covered calls. And what we're looking at right now is the July 9th 650 call, and basically on June 1st we bought it, so basically maybe 30 something days to expiration, 38 maybe. 650 strike, and the premium to sell to open was $3,100. Now, when we closed it, it was 610, 10 days later, and we closed it at $1,900. And basically, we rolled it out to a different strike. Why I like to sell options is all because of this theta decay, and I am Theta Gang, so I like to make this small but great $50 a day out of this 3,100. That's like a 1.6% kind of return. So it's pretty, just 1.6% on the premium, but I mean, obviously you have to put up more capital to make that theta decay every day. And stock price at open was 627, and basically the premium was, sorry, the strike was 650, so pretty close to the money. And every time it's close to the money, the theta or the delta is near almost zero point 0.5. I usually like to sell delta at 0.3. Basically, it's just kind of your exposure to the stock, or in other words, what is the percent that you're going to be in the money when come expiration. So I'm kind of assuming that maybe you guys already know all these things, but I just want to show you guys why I don't like to buy the short-term options. And it's kind of like structured almost like gambling in my opinion, because there's such great drawdowns. And if you think about gambling, like you go to the roulette table and you roll the dice, and there's like a 50%, or no, sorry, you put it on red and black, and then it's either one or the other, but there's a green one, so maybe you have like 48% chance that you hit a red or black. And you have a certain bankroll, and basically you keep taking these bets, structured bets, and over time you could go to zero. And so that's the way I kind of see options, is that maybe you do double or triple up your money really quick, but sometimes if you take too many bad bets, your bankroll can go to zero. And these are some of the risks that I do not like to take, because it just seems like there can be a series of events that are not under your control that can bring you to zero. It's almost like chance. And so everything has risks, but it just seems like the short-term price movement, and based on the speculation of other investors, is not something that I would want to be basing my money on. So for the short-term trader, basically volatility is risk. But if you ask somebody like a Warren Buffett or a long-term trader, volatility really isn't risk, because volatility, all it leads to are errors in the stock price, in which you can buy in when it's dipping really hard. But in this case, short-term trader is risk, because it's a 30-day expiration, and the stock price needs to perform in that 30 days, or else you could very well lose all your money. So for the short-term trader, volatility definitely is risk. So looking at this, I made this graph, and basically what I wanted to do was normalize the change in share price in relation to the premium. And just to show you that the share price kind of follows a leveraged premium percent change. And because this is such a large number, 3,100, 4,000, compared to the stock price of 600, we need to normalize things. And so we just say, like, okay, just changing like from day to day this amount of percent, like a 1%. It dropped a little. You see here, it dropped a little, 1%, right? So this one we saw on the first day, it dropped by 35%. Wow, like what a gain. And these premiums are basically at the open of the market. I mean, I know it just changes with time, but I just kind of wanted to take a sample in the morning, like whenever I wake up. It's just kind of an arbitrary time. It's nothing too specific, but usually wake up around like 6:37, 7:30. So and then yeah, basically the premium just changing crazy. Like the first day it dropped 35%, and then another day minus 27%, then back up 55%. So this premium is changing, and I know it's not perfectly correlated to the stock price, but I mean there is at least somewhat of a correlation. So let's take a look at the yellow. The yellow, there's some small dips, small dip right here, or small bumps right here. And then if we look at basically look at the red one has some huge dips, and the red one is basically just the stock price movement times 10. And why did I choose 10? Just because I just wanted to kind of match this amplitude and kind of sort of match this amplitude, but not really. Just to show you how much leverage is really happening in terms of movement of the option price. And so the blue is the actual option price movement, and we saw the first day was a minus 35%, and then it bounces back up, minus 1%, then now minus 27%, then up 55%. And so these swings kind of correlate to the movement. They're basically magnified the movement of the share price movement, but the only caveat is sometimes implied volatility will create this weird situation where the stock price goes down, and yet the option pricing kind of goes up. And so those are the kind of weird ways in which implied volatility can cancel out stock price movement. But other than that, these big moves in the stock price are reflected in the option pricing movement. You see the regular share price goes up, and then the option pricing goes up, but magnified by maybe tenfold, as you can see in this perfect example here. Not so much here. It's not a perfect one-to-one, but you kind of get the gist that if the regular share price goes up, then the option pricing should go up. It's mechanical. And so we look at the premium, and over this month, I mean, yeah, you know, maybe you would have you basically would have made 61% had you held this option. But I don't like to play the game that way, because it just seems like you can easily go to zero, and this was basically the stock price in relative, like, it just seems somewhat flat around the 600 650 kind of range bound area. So I want to just quickly go over these points, because these are my thoughts. The losses seem structurally like gambling. 30% drawdowns. A series of losses can bring your bankroll to zero. Point two, it can easily go to zero. With stocks, there is a minimum floor. And when I say stocks, there is a minimum floor, that means the hedge funds and the big guys will be buying in at certain levels. Like they're going to be purchasing stocks based on a forward multiple, a forward PE, or a forward price to sales. And so even if you do overpay, over time the company can get revenue, and then with that increased revenue year over year gain, the hedge funds will be buying in at a multiple, and that's how you make your money in the stock market. And the risk of going to zero is greatly reduced with time, because time can correct your mistakes. Which brings me to my next point. Time is not on your side when you buy options. But with shares, time heals your mistakes, because in shares, there's no expiration, and revenue will go up for the company. Ideally, that you did your homework, you picked the right stocks, then time will heal your mistakes. But you pick a company where the revenue's not growing, and then you get into this, will time heal your mistakes? Maybe not. I have no idea. Theta decay of 0.4 to 0.5 on 31. So just looking at these numbers really quick here. Theta decay, it was minus 0.52. Premium right here was 3,100. And so basically $31. I wrote it times 100 shares, because that's one contract. But yeah, that's like 1.6% you're losing on your premium every day. So that's a good amount you don't want to be losing. Share price increases with revenue growth. So we talked about that. Basically, buying an option is buying leveraged stock price. You're trading in your non-expiration share valuation for the ability to take on leverage, because I mean, yeah, you might buy an option and you can make 50 to 60% because you only paid a certain amount of leverage to buy that option for the rights of 100 shares, if that makes sense. So yeah, we already talked about this graph and how the red is 10x the share price increase. But to further bring out my thoughts about why it's leveraged is because, well, basically, if I'm buying an option with 30 days to expiration, that is another form of leverage, because in order to get those rights to those 100 shares, I basically traded in time, if that makes sense. Because in order to buy those 100 shares, Tesla at 650 would be $65,000. And yet for $3,000, you got the rights for 100 shares. And the delta was 0.5. So maybe it moves, your exposure is 0.5 of 65,000, which might be half. But you only paid $3,000 for the rights for those 100 shares. So it's a very differentiated form of margin, in my opinion, because margin, you're saying, I'm going to get a loan from whoever's giving me the margin for, I think Robinhood's pretty low now, like 2%. But the thing is, they want their money back first. If anything goes down and you get margin called, that's the risk of margins. Well, buying options is different. It's like you're trading in that margin aspect, the margin risk, for time risk now, because now you're basically just saying, well, I put in $3,000. The worst I can lose is all my $3,000. And it just seems like gambling. Like, okay, you make a bet and you could lose $3,000, and it's like same thing with options. It's like you can lose $3,000 if your stock price does nothing. And I mean, we basically saw that over here for 22 days. Theta Decay was destroying this option. It was almost down 60% until Tesla popped 5% on one of these days and brought it back to life. So and this is why I don't like to buy options, because I just feel like there's too much noise within this stock. Like, these small movements were magnified by so much, as you can see in this premium here. And I have no idea when the hedge funds are going to rebalance, when they're going to sell their shares, when they're going to buy their shares. No idea when new news is going to come out. And I have no idea whether or not the earnings report will surprise the upside or the downside. So this is very speculative in nature, in my opinion. I mean, if I knew when there's going to be buying demands, like if I wind back the clock and say, okay, over that period where Tesla got added to the S&P 500, yeah, I should have bought some call options. I mean, looking back on it, but I mean, how am I supposed to know that? You don't know that there's forced buying unless there's one of those anomaly events where everybody's forced to buy these shares. And so, I mean, over this random month in June in 2021, I have no idea if somebody else is going to buy in after me. So very, very interesting game. I don't like to buy options. I like to be selling options. And if you gained any value from just me talking about options, just please like and subscribe. I mean, that's all I ask. All right, thanks.